Hello and welcome to the Sand to Pearls Market Commentary. Market week ending July 12th, 2013. Market breadth. With this past week's market rise, our bull-bear point and figure ratio rose from 1.14 to 1.77, advancing further back into bullish territory. The total count of securities in bullish or bearish patterns increased 4% to 2,159. The count of bearish stocks decreased 19%, while the count of stocks in bullish patterns increased 25%. The Sand to Pearls P&F Market Breadth Summary Chart shows us a market now 2 consecutive weeks in bullish territory. Paid subscribers have access to the Excel data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking on Membership, and clicking on Sign Up. For those interested, a free 2-week trial subscription is available. The well-known market breadth indicator, the NASDAQ McClellan Summation Index, rose 245 points for the second rise in 7 weeks. At a positive 498.65 points, it has now risen back above the September 2012 top and continues below the May 2013 top, March 2013 top, the September 2012 top, the February 2012 top, the January 2011 top, and the November 2010 top, and above the November 2011 top, the August 2010 bottom, the March 2011 bottom, the June 2011 bottom, the August 2011 bottom, the December 2011 bottom, the May 2012 bottom, and the November 2012 bottom. Market Gauge Volume Analysis. In this week's volume analysis, the Russell 2000 ended in neither accumulation nor distribution mode. In the last 2 weeks, it had 4 accumulation days and 1 distribution day. Of the other indexes, both the S&P 500 Deposit Receipts and the Diamonds Trust ended in neither accumulation nor distribution mode. Accumulation days are counted when the index closes up on higher volume than the prior day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Russell 2000 ended in accumulation mode. On Tuesday, 7/9, the CCI 20 daily had 6 consecutive days above zero for a change in Woody's trend, and at 186.35 is outside the range for a valid zero-line reject. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the NASDAQ Composite Index began a Woody's uptrend 22 weeks ago, while the daily CCI 20 began a Woody's uptrend this past week. The CCI 20 weekly got a valid zero-line reject signal for Monday, 7/8 open. This week, the CCI 20 rose above plus 100. We will continue to follow the results of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and only one of the bottom 5 industries is negative. Bullish, Internet, and networkers have entered the top 5. Disk drives and S&P retail remain in the top 5. Gold and silver continues to lead the bottom 5. Bearish REITs have entered the bottom 5. Brokers and banks have left the top 5. Focus this week: what is a liquidity trap and why is Bernanke caught in it? Written by Lance Roberts. From the article, The Real Culprits Behind the Declines in Economic Growth Rates, Interest Rates, and Inflation is more directly attributable to increases in productivity, globalization, outsourcing, and leverage. And however, the real test for the success of the Fed's interventions actually began in 2010 as the Fed became the only game in town. As shown above, at best, we can assume that the increases in liquidity have been responsible in keeping the economy from slipping into a secondary recession. With most economic indicators showing signs of weakness, it is clear that the Federal Reserve is currently experiencing a diminishing rate of return from their monetary policies. And this is the article, What is a Liquidity Trap and Why is Bernanke Caught in It? This week's market commentary was prepared by Donald Pearl. We thank you for watching our weekly commentary video and hope that you have a great week coming up. Happy trading!